This is a video on earnings and implied volatility, also known as IV. I'll do this video in two parts. This first part I wanted to be geared just towards beginners who need a general overview of what implied volatility is, and I specifically want to address how IV affects earnings and will affect your trading around earnings. And then later on I may do another video diving into more of the details of IV, how you can do scans for IV, which levels of IV are better to buy options versus sell options, some strategies around trading IV, things like that. But this first one is just going to be a high-level overview of what implied volatility is and then how it affects your earnings. So this is a trade I took on earnings for Weight Watchers. And you may not know how to read these order entry screens. This is actually a statement from our broker when I made these trades. And I'll do another video maybe as well explaining how you read this information. But basically what this is showing here is I bought, BOT, 10 contracts. It didn't fill all 10 at once, so I got 6, and then later it filled 4 right after it. And this was on Weight Watchers, WTW. It was for April expiration, and it was the $50 call, and I paid 55 cents for that. So if we go over to the right, you can see the total amount I paid was the $330 plus the $220. So it cost me $550 to buy this Weight Watchers call for an earnings play, betting that Weight Watchers would go up after earnings. The next day, I sold the 10 contracts of Weight Watchers at $10.20 for $10,200. I turned $550 into $10,200 in one day. This is a real trade I took. This is straight from my brokerage account. So for a limited time only, you can get Mark Kroner's Millionaire Earnings course for the low price of $9.99. And if you act now, I'll throw in a free toaster to the first 100 orders. Okay, I'm joking. I want to show this trade because this should set off some red flags for you guys. First of all, if you pay attention to this screen, if you look over to the left, this trade occurred on February 16th, 2011. Why am I showing you a trade that's several years old? If I'm successful at being able to make earning trades and make a lot of money trading earnings, you would think that I could show you a recent trade. And if you've traded options long enough, you'll come across these option sell pitches for courses, or you'll get stuff in the mail for these courses that's going to teach you how to quadruple your money, trading earnings or buying calls and puts, things of that nature. And if you notice, a lot of times when they show you their trades, there's no dates around it, or they'll show you a chart. Like here's the actual chart of Weight Watchers when I bought this call, and you can see it was trading around 45, and it shot up to almost, well, it did shoot up to 65 that day, and that's how I was able to make so much money. But if you notice, I didn't put any dates on this screenshot. I've even seen where some of these sales pitch guys won't even include the prices on the right because they don't want you to be able to go and look at the chart and try to figure out when this chart came from. So they'll leave the prices off and just show you this chart and say, hey, I got in here and I sold here, and that's how I made so much money. And they'll give you other examples. I mean, I could pull up several other examples I've done over the years as well where I've made, significant amount of money like that on buying options on earnings. But the part they're not showing you is that they're losing a lot of money as well. They're only showing you their good trades. And again, they're having to go back several years to even show you a trade that they made good money on. And if they do show the prices on the right, I'll pull up the chart and find the chart that matches their screenshot and discover that it's 3 or 4 years old. I'll call them out on it and ask them during the webinar or seminar, why are you showing us data that's 3 or 4 years old? If this is something that you're doing consistently, we should be able to see numbers, that are recent. And I think this same logic applies to the Facebook forums we're all using. You see people post trades of the amount of money they're making, and there's the fear of missing out to where you want to jump in and try to replicate what they're doing, but you don't know what's happening on their end. You don't know if they're only showing you the trades they're making money on, and then the next week they could have lost all that. And in my case, on this trade that I just showed you, where I made, $10,000 on this trade roughly. I ended up losing all that money several weeks later on some other earning trades that I took. And for a new trader, this is the worst thing that can happen to you if you have a good trade like this starting off, whether it's an earnings trade or one of your first few trades, because it makes you become overconfident. It makes you think, oh, this is easy money. This is something that I can replicate over and over again. And what you'll find, especially with earnings, is that it's really hard to make money on earnings consistently if all you're doing is buying calls and buying puts. And we'll see here in a second why that's the case. But I really want to show you this in the beginning just to let you know that, don't overextend yourself trading earnings thinking that that's going to be your cash cow and that you're going to make a lot of money because you've seen other people post trades that have made a lot of money on earnings as well. Yes, it's possible. I mean, you can see here, I had that trade where I made a lot of money. This is probably my best trade in my entire 20-year career of trading, percentage-wise, that I've made on a trade. But I have to go back to 2011 even to find a trade like this for you, And I realize not everyone is trying to make 10 times their money, or in this case, 20 times their money on a earnings play. But even getting doubles and triples and things like that, sure, it's possible, but it's not something you're going to do consistently. And if you win on a few earnings trades and get in that mindset that you're going to be able to continually do that, you're going to eventually lose all your money, which is the case I did here, losing that $10,000 because I kept playing earnings with that money. So anyway, let's get into the purpose for this video, and let's talk about implied volatility. You'll also hear that referred to as IV. Some people just call it volatility for short, and you could also see it listed as just vol. So if you look at what volatility is, volatility measures the amount that something changes. And for us, we're looking at the volatility of the stock price. Implied volatility is the estimated future volatility. So what implied volatility is trying to do is trying to account for how much a stock could move up or down at some point in the future. Implied volatility is also a component of the option pricing. So when you go to buy an option and that option costs $5, part of that $5 cost includes the implied volatility. They're pricing in the possible fluctuation of that stock in the future. And implied volatility can make the option price increase in value or decrease in value. Lastly, implied volatility is typically overstated. And what I mean by that is, typically they will price the options a lot higher than they really should be to overcompensate for what they think the volatility would be. So typically your option prices are overstated or overinflated to account for the unknown of volatility that's going to happen in the future. So you're paying more for those options because of the unknown factor for this future volatility. This last part I pulled from Tasty Trade website. I thought it was really good just to read through this. And so why is this important? Why is implied volatility important? Well, options, if you think about it, are insurance contracts. And when the future of an asset becomes more uncertain, there's more demand for insurance on that asset. When applied to stocks, this means that a stock's options will become more expensive as market participants become more uncertain about that stock's performance in the future. When the uncertainty related to a stock increases and the options prices are traded to higher prices, IV will increase. This is something referred to as IV expansion. On the opposite side of IV expansion is IV contraction, or you'll also hear us say IV crush. It's the same thing. This occurs when the fear and uncertainty related to a stock diminishes. As this happens, the stock's options decrease in price, which results in a decrease in IV. I know that's a lot of information, so let's take a look at a quick example to see how IV can affect an option premium. Let's say we have a stock that's trading at $100, and let's look at the weekly expiration for that stock. And let's make the assumption that the stock does not move at all during the week, so it's going to stay at 100 the entire week. If that option is priced at $2 Monday morning, we know that the option will roughly stay at $2 throughout Monday, being as there's been no movement in the stock. And as the days progress, we also know the option will lose value due to theta or time decay, to where when we reach Friday, the option will go to zero if the strike price is still out of the money. But this scenario will change if there's a change in implied volatility, because as discussed earlier, implied volatility can cause an option premium to increase or decrease in value, even if there's no movement in the stock. So let's say the stock still is trading at $100, but on Tuesday at noon, this company announces they're going to release their earnings earlier than they had planned to. The initial plan was earnings was going to be released the following week, but now they've decided to release earnings on Thursday morning of this expiration week. Well, now all of a sudden, there's a new event that's happening in this week that wasn't anticipated, and that event will cause volatility in the stock price. So the market makers will increase the value of these options to account for that implied volatility, that unknown volatility that they know is going to happen Thursday, because there's always volatility typically around a stock's earnings. So they want to increase the value of these premiums to account for that, because that's added risk for the people selling those premiums. When the market maker is selling these options to you as a buyer, they want to get paid enough to compensate them for the risk they're taking on for this event that's going to take place that's going to cause this unknown volatility. So at noon on Tuesday, they may increase this option to say $2.75, when that morning it was only valued at $1.50. And this is with no movement in the stock price. It's strictly going up solely because of this now unknown volatility that's going to happen on Thursday. And as it gets closer to Thursday, the option may still keep going up in value, even with no movement in the stock. Again, that anticipation of volatility that's going to occur on Thursday. And let's say the earnings come out Thursday morning, and when they come out, the earnings are pretty much as expected. They weren't great, but they weren't bad. And so, the stock may move up or down a little bit, but there's not a lot of movement to it. And what's going to happen is the premiums are going to drop drastically due to what's called IV crush. And what IV crush is when implied volatility drops back down to what the normal level would be when there's no potential volatility going to happen. Like in this example before, this 20-cent option on Thursday, it has some implied volatility in it, but it's a very small amount because there's no expectation of there being any news that's going to come out that could cause the stock to trade, really volatile. So the implied volatility in this option is very minimal. Unlike here on Wednesday, the implied volatility in this option is really high because there is this expectation of volatility happening on Thursday. But once the news comes out, once earnings comes out, and now we know the results, volatility will drop back down to its normal level. So you will see an option get crushed. That's why I call it IV crush, because in this case, it would drop from $3 all the way down to 20 cents because of IV dropping down. And the market makers are pulling that implied volatility out they had priced in earlier to now bring the options back down to their normal level. So if you had went in and bought a call on Wednesday wanting to make a bet on earnings, thinking, I'm going to buy this $3 call and I'm going to double it and it's going to go up to $6 because the stock, is going to shoot up after earnings. Even if the stock shoots up, if it doesn't go up significant enough to counteract this IV crush, you could still lose money. You'll see people post in the Facebook forum, the stock went up 5 points today, but my option dropped. And some people will chime in and say, that's because of theta decay. Well, theta decay plays a part into it, but theta decay is a very small part of that option dropping. It's probably all due to IV dropping. So if you play earnings, that's something you need to be aware of, is that these options are already overinflated than they should be. The market makers are pricing them a lot higher than they should be. So you're paying more for this option. Not only that, when the earnings do come out, the option price is going to drop because the IV is being reduced. And then you're going to need that option to go up enough, probably over your strike price, to be able to make any profit on that option. So the takeaway from this is buying calls and puts to hold through earnings just don't do it. And the reason for that is it's a very low probability of making a profit. I put less than 20%. It's probably less than that because most people are picking the far out of the money strike prices that probably only have a 5% chance of success. And again, the reason why that is such a low probability is because of how the implied volatility crush is going to affect those option prices and the fact that you need that significant move to happen for you to make money. And that's what the next bullet point addresses is the stock will need to move more than the expected move to counteract the IV crush. So every week you can look at an option chain and see what the expected move is for a stock. And if that expected move is 10 points, you would need the stock to surpass that 10-point move to be profitable. And again, it's less than 20% chance that's going to happen. If you're going to play earnings, the best strategies to use is a sell strategy like credit spreads or iron condors. And I realize not everyone can trade those types of strategies in their account. So if you can't do that and you only can buy calls and puts, the best thing to do would be to buy your call or put 2 to 3 weeks leading up to earnings. Because since we know that implied volatility will start increasing as it gets closer to the event, in this case the earnings date, you can actually profit just off that implied volatility increase. If you buy a call 3 weeks in advance, as it gets closer to that date, the premiums will increase in value to where you could potentially sell it right before earnings and make a profit just off that implied volatility increase. And then also, a lot of stocks will increase in value going into earnings. The stock will run up as it gets closer to earnings, and so you can also profit on the movement of the stock as well. And then lastly, you could also trade after earnings. After the earnings come out and the IV crush happens, now options will be a lot cheaper to where you can afford to buy strike prices that are closer to the stock price, and now you can trade the stock based on what your thesis is of what it will do now that the earnings have come out. If the stock ran up a lot because of earnings and you think it's going to continue to run up, maybe you buy some calls at that point. Or if you think it ran up too much after earnings, maybe you buy a put thinking the stock is going to drop and pull back after that initial run up. So that's really all I wanted to cover, is just more so to get you to understand that when trading earnings, it's really risky if all you're going to do is just buy a straight call or put. That sure, there are some huge home runs you can hit if you get really lucky, but in the long run, if you continue using that strategy for earnings, you're going to potentially lose all your money.